Welcome back. Take a look at futures this morning. Trading down. Dow Industrials down 54. The Nasdaq down 52. Stocks certainly surged in the month of November, but the rally is taking a breather this morning. For the month of November so far, the Dow Industrials are up 5%. The Nasdaq is up better than 7%, almost 8% in November. The S&P 500 higher by 6.25%. Joining me right now is Piper Sandler's Managing Director and Chief Market Technician, Craig Johnson. Craig, great to see you. Welcome back. Tell us your technical perspective of the broader market given these moves.
Well, Maria, over the last several weeks, the market got extremely oversold. And when we look at the overall breadth of the market, we got the levels that we rarely see. In fact, we'd only seen it about 20 times or 23 times going all the way back to the 1960s. The market was due for a pretty solid bounce. And post that bounce, we've actually now recaptured the 20-period moving average, the 50-day moving average, the 200-day moving average, and the uptrend off of the October lows last year. The market is setting up for the next leg higher, and I still think that we've got meaningful upside, Maria, back toward 48.25 from our perspective, which is really retesting the old highs of 21.
So you think if we put money into the market today, we'll be better off, what, in the next month? You think we'll have a year-end rally then?
I think you're having a solid year-end rally, and it might last a little bit longer into the early part of next year. You got to keep in mind that the Fed very well could be done raising rates. And if the Fed is done, history shows that from the last hike to the first cut, markets have typically gone up about 13 and change percent over that period of time. So a lot of good things are coming together, Maria, and 10-year bond yields are coming down. So there's an opportunity for this sort of depressed market to take another leg up.
So tell me about the groups that you're expecting to lead that rally, because, of course, year to date, it's been a lot about AI, big tech, that so-called Magnificent Seven technology companies. Is that where you want to be placing money, or what? How do you allocate capital here?
Yeah, in terms of allocations of capital, we see the best relative strength coming in industrials. We see it coming in technology and the services stocks. And now, in terms of the Magnificent Seven companies, they have done extremely well. But if you look over the last week or so, the last 10 days, shall we call it, we've actually started to see a pretty good catch-up happening in small and mid-cap stocks. And if you think about the composition of the Russell 2000 index, Maria, it is primarily healthcare, financials, and industrials. And from my perspective, if the financials start to pick up as rates start to normalize, we're going to see a very nice move up in the Russell 2000 index.
Craig, what does retail tell you right now? I mean, Walmart is down on a disappointing guidance, even though the earnings seemed better than expected. The stock is down, and that's a Dow component. It's expected to cut about 70 points off the Dow at the open. So it's basically Walmart, which is pressuring the Dow Industrials this morning. Any takeaways on retail?
Yeah, thinking about retail, I think right now, Maria, consumers are making a choice. And if they don't hear a message that they like, they're simply not spending at certain stores. And you think about Walmart, they certainly are pressuring the Dow here this morning, but they've had a very nice trend. They've done well. But it looks like in some of the news releases and some of the comments that have come out, they said that deflation could be a possibility next year. That's a word that I have not heard in quite some time, given all the inflationary pressure. So I find that pretty interesting. But again, Maria, consumers are just making different choices. They're being more conscious as to where they're spending their dollars. And Costco, Walmart seem to be getting the dollars while Target has been losing.
Well, the banks have had a tough time last couple of months. What do the banks tell you right now as far as the way they're trading?
Well, interesting. Coming out of the March period of time, basically the Fed went 11 rate hikes in 20 months. I'm not surprised if something broke. Then the Fed had to come in and fix it all. And they fixed it by basically taking into paper if there was to be a liquidity issue. But now the banks are starting to show signs of improvement. The curve is getting closer to normalizing. And as that happens, there could be a very meaningful rally for the banks as you get into 2024. But that's still yet on the come. And as you look at the charts, you're starting to make some higher lows. And you're starting to see kind of these double bottoms forming in the financials. It's early, but you got to start allocating a little bit of capital in some of these names. And you look at the KRE, Maria, just over the last couple of days, and you've rallied right up to the 200-day and starting to reverse it.
Yeah, especially since this debate is surging as far as whether or not the Fed is done. Any thoughts on whether or not we're done with the rate increases at this point, even though we know that Chairman Powell said that inflation is not at his target just yet, leaving the door open for further?
Well, if I go out and I look at sort of the interest rate, world interest rate probabilities, basically it's at zero. So there is no sort of indication. And you start looking out into mid part of next year, and there's nothing but sort of indications of rates being cut. So I think at this point in time, in the rally we've seen, the market believes the Fed is likely done at this point in time.
We're looking at a market, however, that has had some impact of the 11 rate hikes. As you said, it was go to 5% in a hurry, and yet there are other areas that are doing just fine. So, Craig, are you surprised at the amount of time it has taken to actually feel an impact of these higher rates?
Well, I just don't know if this sort of weakness has to be evenly spread across all industries, all sectors across the board. Certainly, we had seen some housing slow down to a degree. We've seen some layoffs in businesses. Some of the big tech companies have had some layoffs. We've seen some of those challenges, Maria. But again, this is a pretty resilient country, a pretty resilient economy, and it seems like we're still doing fine. We haven't seen that many layoffs. And I think also a lot of management teams, Maria, are looking at this and saying, if I let this person go at this point in time, it might cost me 20% more to hire the same person back when I do need to add more staff in the future. So I think they're being more conscious of hanging on to employees. Bonuses may be weaker in the future, which we hope not, but could be the case even though they've kept more of these employees on. Yeah,
and rates where they are off of the highs of the last couple of weeks. I mean, there was a moment in time there just in the last couple of weeks where people were like 5%. I'd rather take money out of the stock market and put it in fixed income if I'm going to get 5% in the safety of treasuries.
Sure, and I think for a lot of people that are sort of risk adverse, that makes sense. But if you're investing for the longer term, I think equities is still the right place to be. And then in terms of 10-year bond yields, Maria, we've had a 40-year secular reversal in 10-year bond yields. And the other two times you can come back and see those sort of longer-term trend changes happen would be in the early 1980s and also in the 1950s. Don't forget the 1950s and 60s were pretty good decades for stocks to work. But more importantly, thinking about the lessons we learned from the 1980s, it took 7 years from the peak of interest rates until you finally reversed the uptrend. And then you had a meaningful relief rally. Maria, I can tell you right now here, I think you're going to see rates continue to come lower. I would not be surprised in the next couple of months to see a 3 handle on the 10-year bond yield.
Wow.
Because you need to have that check back ultimately. And that does not mean that rates are done going up over the long term, but in the short term, a healthy check back is always what you normally would see.
Yeah, that's
Former
incredible.
technicians like Ron before would tell you that you need higher highs and higher lows. And right now, you haven't made that kind of lower high yet.
So what's your expectation for 2024, Craig?
Well, my expectations are that, number one, I think the Fed will clearly be done next year. Number two, my expectation is that the curve is going to normalize. I think that'll be positive for banks. I think you've got sort of modest upside. If you go back and you look at history, there's only been 4 down years in an election year. You've only had 2 recessions ahead of an election year. So from my perspective is the normal sort of return is anywhere from, say, up 10% to up 20% in an election year on a total return basis. Just again, looking back at history as sort of a guide.
Yeah, okay, great information from you. I should point out that we are getting economic data right now. It's crossing the tape, and we've got it on the bottom of the screen. Jobless claims for the latest week at 231,000. That is higher than the estimate, which was 220,000. And exports were down 1.1%, much higher than the expected, down 0.5% estimate on that. Craig, it's always a pleasure. Thanks very much for being here this morning.
Thank you, Maria.